Hi, my name is Dr. Annette Moultrie, and this is Accounting 101. So, let's see what we will teach in this video. But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Also, click on the notification bell so you'll be notified of upcoming videos. Okay, here we're getting to Learning Objective 3. Learning Objective 3 is record transactions in a journal and post journal entries to the ledger. So how do you record transactions? Source documents, they provide the information accountants need to record accounting transactions. So based on these documents, the business can determine how to record transactions. So what are these source documents? After source documents are prepared and transactions are analyzed, the next major step in the recording process is to formally enter the transaction information into the general journal. So essentially, the general journal is a chronological record of each of the transactions recorded in the standardized format. Some of the source documents include purchase invoices, which are documents that tell the business how much and when to pay a vendor for the purchase on account, such as office supplies or equipment. Another source document is bank checks, which are documents that illustrate the amount and the date of the cash payment. And another example is a sale invoice or sale invoices. They're documents that provide to the clients when a business sells services or when they sell goods. They tell the business how much revenue to record. Again, accountants use the source documents to record transaction in the journal. So a journal is a record of transaction in date order. The journal is not a record holding of the accounts. So data must be transferred from the journal to the ledger through the posting process. Here you see in this example, transactions are recorded in a journal. You have a debit to cash of $30,000 and a credit to Bright Capital Owner Contribution. So this data is posted or transferred to the ledger. Cash is debited for $30,000 and Bright Capital is credited for $30,000. So what are the steps? What are the steps to journalizing and posting transactions? The journalizing and posting process has 5 steps. Step 1 involves identify the account and the account types. Is it an asset, liability, or equity? Step 2, decide whether each account increases or decreases, and then apply those rules of debits and credits. Step 3, you record the transaction in the journal. Step 4, you post the journal entry to the ledger. And step 5, you determine whether the accounting equation is in balance. Now, you can use a modified version of the steps for analyzing accounting transactions to help when you are recording transaction in the journal and then posting the journal entries to the ledger. Here you see in transaction 1, the e-learning company received $30,000 cash from Sheena Bright, and the business issued capital to her. So in step 1 of journalizing and posting transactions, you have the two accounts involved. You have cash, and then you have Bright, which is capital, equity. Cash, and then you have Bright capital, okay? Step 2, both account increases by $30,000. The debit increases asset, the credit also increases capital. In step 3, the transaction is recorded in the journal with a journal entry. You have the date of the transaction, which is November 1st. Step 2, debit account name, which is cash, and the amount. Step 3, you have a credit account name and dollar amount. The credit account is indented here. You have Bright capital, $30,000 credit. And step 4, you have a brief explanation, which is owner contribution. Step 4, the journal entry is posted to the ledger. The journal entry is posted to the ledger in step 4. The dollar amounts are transferred from the journal to the ledger with a debit or a credit identical to the debit and credit used in the journal. Now this step is automated when you have a computerized system to use to record the business transaction. In step 5, the next step is to determine if the accounting equation is in balance. As you can see here, you have the two accounts, cash and capital. And you'll see that it is in balance. The example here in transaction 2, Smart Touch Learning paid $20,000 cash for land. So step 1 of journalizing and posting transaction is the two accounts involved are your cash, which is an asset, and land, also which is an asset. So, because they paid $20,000 cash for the land, that means cash will be what? Credited, because it will decrease the asset account, right? But land will be increased with a debit. Land is an asset that is increasing, so it's a debit. Cash is an asset that is decreasing, so you'll have a credit. There's another way to show the two accounts where you have the cash and then you'll have the land. So this transaction is recorded in the journal, which is step 3. Step 4, the journal entry is posted to the ledger. So in step 3, you have land debited for $20,000 and cash is being credited. Okay, and then here you have the information. And this is where the journal entry is posted to the ledger. Cash started out with $30,000, is decreased by $20,000, but land is increased by $20,000. And in step 5, the accounting equation is still in balance because land was increased by $20,000. And the remaining balance in cash is $10,000. So 10,000 plus 20,000 is 30,000. And you'll see that your left side is in balance with your right side. Assets equal liability plus equity. In transaction 3, Smart Touch Learning buys $500 of office supplies on account on November 3rd. The supplies will benefit the company in future periods, so they are an asset. They are an asset until they are used. So the two accounts involved here are office supplies, which is an asset, and accounts payable, which is the liability. So office supplies increases with a debit, and accounts payable increases with a credit. In transaction 4 here, on November 8th, Smart Touch Learning collected cash of $5,500 for service revenue that the business earned by providing an e-learning services for clients. So here in this transaction, the company collects $5,500 cash. So cash is debited because it's increasing cash. Okay? It's a service revenue. So service revenue is credited. The two accounts involved are cash, which is an asset, and service revenue, which is equity. So cash increases with a debit, and service revenue increases with a credit. Here in transaction 5, on November 10th, Smart Touch Learning performs services for clients for which the clients will pay the company later. The business earned $3,000 of service revenue on account. On account. So the two accounts that are involved here are accounts receivable, which is an asset, and service revenue, which is considered equity. Okay? So accounts receivable increases with a debit, and service revenue increases with a credit. In transaction 6, Smart Touch Learning paid the following cash expenses on November 15th. They paid office rent of $2,000 and employee salaries of $1,200. So there are 3 accounts. One is rent expense, salary expense, and then we have cash. Rent expense is an equity, and so is salary expense. So your cash will decrease by $3,200 with a credit. And the 2 expense accounts, they are increased with a debit. A compound journal entry has more than 2 accounts, but the total dollar value of the debits must equal the total dollar value of the credits. Here in transaction 6, you see the payment of expenses with cash. So the debits to the expense accounts increases the expenses and in turn decreases equity. Here you have the November 1st, $30,000. Then on November 2nd, cash was credited for $20,000. November 8th was I think it was the payment that was received, $5,500, because of course that is an increase to um, asset. And then there's a $3,200 that was credited. So you're decreasing cash, which is an asset account. You have your rent expense, which was paid $2,000, and the $1,200 on November 15 salary expense. So the overall effect of an increase to an expense account is a decrease to equity. Okay? And expenses increase because the business has more expenses now than before. In transaction 7, the company paid $300 on the account payable created in transaction 6. Transaction 3, with your previous slides. So the two accounts involved here are accounts payable and cash. Cash is an asset, accounts payable is a liability account. So there's a debit to accounts payable and a credit to cash because the company paid on the accounts payable account. Here at transaction 8, the company collected $2,000 cash from a client in transaction 5. So the two accounts involved here are cash and accounts receivable. The company received cash on account. So cash is now debited for $2,000. Accounts receivable is credited for $2,000. So again, we know that cash, because of the debit, cash is increased, right? But accounts receivable is decreased because of the credit of $2,000. Transaction 9, on November 25th, Sheena Bright withdrew cash. She withdrew cash of $5,000. So the two accounts involved here are Bright withdrawal, where it shows that she withdrew $5,000, and then cash is credited for $5,000. So cash is decreased with a credit, and Bright withdrawal increases with a debit. So the debit to Bright withdrawals decreases equity. Here in transaction 10, on December 1st, Smart Touch Learning prepays 3 months office rent of $3,000. 3 months office rent of $3,000. The two accounts involved here are cash and prepaid rent. Now, prepaid rent is an asset because the company will receive a benefit in the future. Therefore, cash decreases with the credit, and prepaid rent expense increases with the debit. Transaction 11. On December 1st, Smart Touch Learning paid employee salaries of $1,200. The two accounts involved here are cash and salary expense. Now, cash is decreased with a credit of $1,200, and salary expense is debited for $1,200. So cash decreases with a credit, and salary expense increases with a debit. So the debit to the salary expense account will also decrease equity. In transaction 12, on December 1st, Smart Touch Learning purchased $60,000 in exchange for a note payable. The two accounts involved here are building and notes payable. Building is considered an asset and notes payable is a liability. So building increases with a debit. It's an asset account. Notes payable is credited for $60,000. So notes payable increases with a credit. Here on the T account, you have the building account and then you have the notes payable account. $60,000 is a debit to building, which is an asset account, so it increases. Notes payable is a liability account. A credit of $60,000 shows an increase. Transaction 13. On December 2nd, Smart Touch Learning received a contribution of furniture with a fair market value of $18,000 from Sheena Bright. In exchange, Smart Touch Learning gave her capital. Okay, so the two accounts involved here, furniture, which is an asset, and then you have Bright Capital, which is an equity. So furniture increases with a debit of $18,000 because it is an asset account, and capital is credited of $18,000, which increases with a credit. On the T accounts, you see furniture and Bright Capital. The debit to furniture and the credit to capital. Transaction 14. On December 15th, Smart Touch Learning received a telephone bill for $100 and will pay this expense next month. So the two accounts involved here are utility expense, which is equity, and utilities payable, which is a liability account. So this is what we consider accrued utility or accrued because they received. Why is it accrued? Because this is an expense that will be paid later. They accrued it, but it's going to be paid later. So accounts payable is credited for $100 and a utilities expense is debited for $100. So utilities payable increases with a credit and utility expenses increases with a debit. Transaction 15. On December 15th, Smart Touch Learning paid employee salaries of $1,200. The two accounts involved here are salary expense and cash. You see that salary expense is debited, cash is credited. And here we see all the transactions that occurred with the T account. You have your cash and then you have your salary expenses. Okay? These are all the transactions that occurred to the cash account, and here the T account salary expense, the transactions that occurred. Transaction 16, unearned revenue. On December 21st, a law firm engages Smart Touch Learning to provide e-learning services and agrees to pay $600 in advance. $600 in advance. So we have two accounts here. You have your cash, and then you have your unearned revenue, which is a liability. Why is it a liability? Because they're paying in advance and the services will be completed later or in the future. So cash is debited for $600 and unearned revenue is credited for $600. Collected cash for future services. Cash increases with a debit and unearned revenue increases with a credit. And here you see for transaction 16, the two T accounts, cash and unearned revenue. This is the added $600 here that the company received. And this is the unearned revenue. Transaction 17 on December 28, Smart Touch Learning collected cash of $8,000 for services revenue that the business earned by providing e-learning services for clients. So the two accounts involved here are cash and service revenue. Cash is debited because it's increasing, and service revenue is increased by $8,000 with a credit. Performed services and received cash. And here you see in transaction 17, earning of service revenue for the cash. This is the cash T account, and this is the service revenue account. Here you see the $8,000 for the service, for the cash that was received, and for the service revenue. Now, after recording the journal entries, the amounts are posted to the ledger. In the next slide, you'll see in Exhibit 2.7 a summary of the ledger accounts. Now, the accounting equation is in balance. It is in balance as assets equal $114,700 and liabilities plus equity also equal $114,700. Here you see all of the assets. Assets equal $114,700. You have your liability and your equity. Remember the accounting equation. It is assets equal liabilities plus equity. Assets equal liabilities plus equity. Assets total again is $114,700. Your liabilities is $60,900, and your equity is $53,800. When you add these two together, you will have your $114,700. Here on this slide, it illustrates the T accounts. The next slide will show you an alternative, which is the 4-column account. So here you have the T account for the cash, right? So it also shows the ending balance. Remember, cash is an asset account, so the ending balance will always be a debit. You see the ending balance of $12,200. And the 4-column is an alternative to the T account. So the 4-column account has debit and credit columns, as well as a running balance of the accounts. Now, similar to the T account, the 4-column account lists the date of the journal entry, right? A posting reference, and the debit and credit amount. Here in Exhibit 2.9, it shows the posting and associated posting references for Transaction 1 of Smart Touch Learning. Now, this process is automated in a computerized environment. So here you see the page number from the journal. And here you see the account number from the journal. Now, this is the end of Learning Objectives 1 through 3. Learning Objectives 1, 2, and 3 were covered in this video. The next video will involve Learning Objective 4, which is prepare the trial balance and illustrate how to use the trial balance to prepare financial statements. Again, learning objective is prepare the final balance and illustrate how to use the trial balance to prepare financial statements. That will be covered in our next slide, our next video. Thank you for watching. And please, if you haven't already, please click the subscribe button below.